So I'm in some very serious trouble. My account is at new lows, lower than it was whenever I first started trading options. This market has changed, and I want to go over what happened today and then what we can expect to see the rest of the week. So we can see here I am down $3,000 on the day. My net liquidation is $13,600. Now that's up after market right now, but right after the market closed, that's where I was at. The E-mini S&P 500 is down to $5,100. I'm down nearly $2,000 on the day. We'll get into details on what I did there. Copper, it's up, but it's kind of settled where it's at, but I'm still down on the day with that. Still up 180 overall. T-Flow, not much to go on there. And then Tesla, it tanked as well. We'll go into details on that. We're down $9.50 there, $700 on the day, and $2,000 since I've opened the position. So with the market being down, I decided to go ahead and start selling calls against my positions in the E-mini S&P 500. Now I've got put spreads on, and I started doing call spreads at the 20 delta. The market was going down so much, and it was going very fast. I collected $900 in premium, but I ended up selling a couple of them just because they had nearly reached the full profitability in one day. So I decided to go ahead and buy them back, and that was 2 positions there. I may put on another call position tomorrow. I just went ahead and closed them because there's no point in holding them if they're already near max profit. So right now I have $827 of premium in the bank right now, and I'm hoping to buy those back later on to collect premium. And that's the name of the game here. Even though that my positions are in the money in the E-mini S&P 500, number one is I have time. And with the time that I've got with the contracts that I have, I'm going to be selling calls to collect premium. Now, this is a new strategy. I don't know if it's going to work or not, but the goal of the name of the game is to collect premium. And so it's not time to just start closing positions because I'm in the red. It's time to start collecting premium and getting time before the market starts coming back up. So the markets are down because of the conflict going on in Iran and Israel. And not to mention we have the high CPI report coming out. Crude oil is up. That's an inflation indicator as well. It's going to be fueling more inflation potentially for the rest of the year. So the outlook has changed overall in the market for the rest of the year, and we can see it in the stock price right now. We are dealing with a different market right now. It is a falling market. It is correcting. With the E-mini S&P 500, we are below the 50-day moving average. The 8 EMA is starting to cross the 50 moving average. So we're starting to see a trend toward the downside. We don't know where the bottom is. Right now, after market, we can see a green candle here. This could be a bottom, but there is no telling where this market will go. We do not know where the bottom is, and it might be a good while until we actually start seeing a pullback up to a new high. Something to keep in mind that now that we've broken this 50-day, we are dealing with a falling market right now. And so I want to go over some of the things that I've learned being in this change of market and what I want to do next time. So to give you a visual of the positions that I placed today on the E-mini S&P 500, you can see here the puts that I've got that are in the money. Now these are puts that I've bought and sold, so it looks like there's a lot, but really you can just cut it in half. It's really the puts that I've sold are in this lower portion here, and this is the current price. So we can see there that it has fallen, and it's not in good shape right now. My position is not very good, but I have some calls that I've sold against it to kind of hedge, collect some premium while the price is down. I don't believe the price is going to be coming up into my calls anytime soon. So I'm just waiting until I get a good enough premium for those calls. I'll take them off and then try again the next day, or just continue to collect the premium here. Changing the game here. We're dealing with a downtrending market, so it's time to start putting some calls on. What's interesting about doing the calls here is it's not costing me any extra buying power. I'm collecting premium for no additional buying power. So even though I don't have a whole lot of freed up cash, I'm able to place these calls as a hedge or a way to continue to make money without using any extra capital. My big threat right now, though, is that my positions will be closing at expiration in the next week. So I have to make a decision if the price doesn't come back around, what I'm going to do with my put spreads when they're in the money and getting close to expiration. I've got a couple options here. I'm thinking that I can do each individual option and roll it out in time, or take them and group them and then try to offset with the contracts. So try to figure up my loss for all of these positions and combine them, and then roll it out for a credit as one position with the same number of contracts. The other option is that I can roll it out in the same way, but do a wide spread with one contract as a put spread. So I'm not exactly sure what I want to do, what's possible, but that's kind of what I'm looking at in the future here. When I need to roll my positions out, I may be doing them in clusters instead of individual contracts, because it is a lot to manage. I have a lot of positions here that are in the money, and the timing of this strategy was terrible. But then again, it's a good learning lesson here on the strategy, and it helps me work out and maneuver these put spreads and show what kind of possibilities there are when things go against you in the market. So Tesla came out with 3 pieces of news over the weekend. Robo-taxis would be coming out in August. The FSD software feature would be priced at $99, down from $199 a month. And this morning they came out with layoffs in some of their production facilities. So on that news, and with the overall market, Tesla tanked. And we can see now that it is actually following this downward trend line here, and it is settling here at around 160 again. So we're almost going to be seeing here a triple bottom here, or it could eventually break this level. What we want to happen here on Tesla is that it hits this price level and can continue to go around and correct. If it doesn't, if it breaks this level, we could continue to see new lows in Tesla. We could see somewhere around 150, new lows that we haven't seen yet this year. This doesn't set us up very well for my initial plan of getting out of the position before earnings. Earnings come out in April 23rd. That's coming up here in just a few days. A lot can happen between now and then, but the outlook is looking pretty grim. So I have 2 put spread positions open on Tesla, and one is at 180, the other one is at 175. We can see that we're in between the spread here of the 2 positions. With Tesla, I'm willing to hold the position because I believe it's just a matter of time before Tesla's price just turns around and starts going up. There's a lot of potential in the stock, and I believe that it's down right now because of outside forces. I think when the market environment changes for electric vehicles, Tesla is also going to turn around to the upside. So copper continues to make some pretty crazy moves. It's high volatility, up to 100 IVR, and it is moving up and down. I'm not sure exactly how to read the chart on it because it doesn't matter what the candlesticks say, it's going to be moving however it wants to. It is following the ADMA. It doesn't want to break that right now, which is a risk for me because I have my position at $4.65. That's where my call is. And so I want it to be in between my call and my put. So I really want it to come back down to that 425. What I'll be looking to do if it doesn't come back down anytime soon is to bring my put position up closer to the current price to collect premium in case it does go past 465. Then I can at least make the adjustment and start trading an inverted strangle if I need to. My understanding of the inverted strangle is that you need to have enough premium up front in order to collect some profit. I need to make sure that I'm not too passive and not collecting enough premium in case that does actually happen. So what's my learning lesson in all of this? The first lesson that I've learned here is I have too much capital tied up in the positions that I've got. I have my buying power usage at 126% right now. Now my option buying power is above 0, which is fine. I'm not going to get a margin call, but I'm leveraged here because my capital requirement is higher than the actual money I have in my account because my net liquidation is so low right now. The other reason why I don't want so much capital in the positions is that when the market turns like this, I want to have cash available to put on positions. Now, I've got T-Flow right now that has about $2,500 tied up that I can liquidate at any time and open up a position. The problem is that if I liquidated that, my buying power usage is still at around 100. So I need to make sure that I have a good amount of capital to cover my positions for one, and also to be able to open up new trades when opportunity strikes. Right now, overall, we're seeing IVR on the E-mini S&P 500 at 76, when just a few weeks ago, it was down to like 20. So we can see here that volatility is up really high, and I don't have any money to open up any trades to make some good premium. So I'm missing out on some opportunities right now because the IVR is up and I don't have any money. So the second lesson that I've learned here is that when IVR is low, keep a good amount of capital in cash. Now, how much is that? It's different for everybody. I'm thinking around 50% in cash when IVR is at a certain level. I don't know exactly the details here, but that's the lesson that I'm learning today, is that make sure that you have enough cash for when volatility goes up. When you're in a high IVR environment, you're able to open up trades and make some good premium. The third lesson that I've learned is to manage and not panic. It would be very easy for me today when the market was going down is just to sell all my positions because I think the market is going down. That's not the way that I want to play the game. I want to play by collecting premium. No matter if the market is going up or down, my goal is to collect premium regardless of what happens. Yes, my net liquidation is down, my P&L on the day is down, but my positions have not changed. So I can continue to adapt by selling call positions and rolling my positions out in time when needed. Because what I have going for me is time. I want to give myself enough time to be right. So if I'm selling in a panic because the market's not doing what I thought it would do, then I'm just acting on emotion, and that's not going to get you anywhere. So you can see my account is hurting pretty bad right now. The most important thing about all of this is to learn. How much would you pay someone to learn the lessons that you would learn going through this process of positions going against you, how you manage, how much money should you have in each position? Learning these things is priceless because I'm just starting out. I've been trading options for roughly 6 or 7 months. And so the lessons that I'm going to learn are going to be with me for a long, long time. So I want to continue to learn and grow. Even if my account is going down, this is the learning curve that I'm going through that's going to help me in the future. And if you want to join me on this journey, I want to get a 50% by the end of this year. And hey, maybe I'll lose 50% by the end of this year. But if you want to watch me on my journey, hit that subscribe button. I give daily updates on how my account is doing, when the market is open, and when I learn something, I try to share it with you. So hit that subscribe button. If you like this video, hit the like button, and we will see you on the next video.